Hello, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. Okay, let's get into some listener questions. And the first question is from Ronaldo. It's a bit of a long one, but essentially what Ronaldo is asking is that they already own two residential properties in joint names, and the next investment property they're thinking about buying a commercial property. And he's asked me, what ownership structure and financing structure would I suggest? And the first option is to put it in the family trust, but have 100% of gearing. And Ronaldo acknowledges the downside to that is that it's likely the property will be negative cash flow. And so any negative cash flow, the tax loss that is, will be trapped inside the trust, carried forward to offset future income profits, hopefully. The second option is, whilst you might borrow the full cost, only let the trust borrow, say, 80%. So it's relatively neutrally geared. And in that situation, the other borrowings for the top up 20% are either going to come from offset savings, which is really kind of cash contribution, or repaying the loan, a non-tax deductible loan from cash flow. It wasn't clear, but really putting in some cash into the investment. And the last option was to put it in joint or single names, so personal names, I should suggest. The critical element here that Ronaldo hasn't provided me that I would really be thinking about is, what are the components of the return and how long am I going to own this property for? And finally, will I be in a situation where I think there's a high probability of needing to sell the property, or is the goal to really hold it in perpetuity with potentially never selling it and then handing it over through my estate? That's what I'd really like to know, because then I can kind of weigh up, okay, what are the income tax attributes of this property? So if the yield is okay but not massive, it's going to produce some negative gearing benefits, in which case then I'd probably want it in personal name to maximize those negative gearing benefits, particularly if the answer was, no, I'm never planning to sell the asset, in which case the capital gain may arise in the future, and it could be many decades in the future. So I wouldn't be placing a lot of importance on minimizing that capital gains tax outcome. Conversely, I guess a flip side to that scenario would be, it's a very high yield, so therefore the negative cash flow isn't that material. And if I plan to sell the property within the next 10 years and crystallize the capital gain, well, then I'd put greater weight on having the flexibility to distribute that gain to either a corporate beneficiary, so a company, or even family members. Now, a company can be a great option in this situation, because essentially you distribute the capital gain into a company, you pay your 25 or 30% tax, and then you drip feed that profit out each year. You could do it over, as many years as you want, over 20 years if you like, and you'll always get a credit for the tax that you paid. So potentially, if you're able to drip feed that capital gain by paying dividends out over a 20-year period, you potentially end up paying zero tax on the gain. So in that regard, if I was planning around a capital gain, then I would be cognizant of that. And the final consideration would be land tax, and depends on what state you're buying the asset in. Just be careful with commercial properties. I don't think I mentioned this, but Ronaldo said his budget is 800 to 900,000. Be careful with these sorts of commercial properties. I know they're they seem like all the rage at the moment, particularly if I, follow some people on LinkedIn and other social media. They're talking about, these are the properties we just bought for clients. Just be careful with them. That's all I'm saying. I think in some situations they're advertising, oh, look, this thing got a 6% yield and, it's enjoyed a lot of capital growth over the last couple of years. And so then when you work out the total return, total returns north of 10% being income plus yield, well, it's never going to do that on a long-term basis. So, you could be buying in at the peak of the market, or buying an asset that has had in recent times inflated returns, and you could end up with an asset over a very long period of time that produces a pretty ordinary average return over that period. There's no free lunch here, of course, and it depends on the type of asset. If it's an industrial property, they tend to be more income-driven assets, although, as I said, the last 5 years, there's a lot of examples of industrial property that have also enjoyed a lot of capital growth. I'm just saying that I wouldn't expect that to necessarily repeat itself. Anyway, so I don't know what the answer answer is there, Ronaldo, for you. It really depends on some of the things I just spoke about. But hopefully that gives listeners, a better appreciation for the approach or the additional questions that I might have and that you might want to consider when contemplating a similar situation. Okay, the next question is from John, and John has a question regarding Div 293 tax, which applies if your adjusted taxable income, which essentially is, your PAYG income or business income, excluding any rental losses, plus any super contributions, superannuation guarantee, the employer contributions that you've made. If that's over $250,000, your contributions will be taxed at an additional 15%. So the original 15% plus an additional 15%, so 30% in total. You're still better off, 17% better off, because if you didn't make those additional contributions, if they weren't compulsory, you would have been taxed 47%. So you're 17% better off. Although when people get their Div 293 bills, which typically are a few months after you lodge your tax return for that income year, it comes as a bit of a surprise and everyone feels like it's an additional slug that, they've already paid a lot of tax. And I get that. I don't disagree. The premise around Div 293 was that higher income earners were getting a much larger benefit from making tax-deductible contributions into super, so 15% versus 47%, where lower income earners, their average tax rate might be 30% versus 15% in super. And so they wanted to sort of close that gap, which I guess has some merit, but, I'm not going to sit here arguing for higher taxes. Anyway, John's question was, if he contribution split, would that change his Div 293 liability? Because he said his wife was on maternity leave, didn't earn much income in the 24 financial year, so potentially he could have split his contributions over to her. And would have that helped him minimise or even potentially avoid Div 293 tax? Sorry, John, it doesn't. Because you still receive those contributions. The contribution splitting is an after-tax thing. And so what happens with contribution splitting, if I put in $10,000 into my account, it's taxed at 15%, so $1,500. I've got $8,500 left. In this year, if that were concessional contributions, I can then move that $8,500 into my wife's account. That's an after-tax thing, after contribution taxes and so forth. So the contribution splitting, you couldn't do anything about it. In fact, let's just talk about Div 293 tax. There's nothing you can really do about it. If you were close to the threshold, the $250,000 threshold, which includes obviously your PAYG income, any bonus income and any super contributions, if you were like a couple of grand over that threshold, look, you could make some deductible donations, for example, to bring your taxable income below that, although you're not going to pay a lot of Div 293 tax anyway in that situation. But unfortunately, guys, so if you earn more than $250,000, your contributions are going to be taxed at 30%, and there's really nothing you can do about it. And the only thing you can do about it is just remind yourself that you're 13% better off. You're still getting a tax benefit. You're still getting money into an environment that is incredibly attractive from a taxation perspective. So, I guess that's the only silver lining I can share with you. Now, the next question I've got is from Sam. It's actually a very long question. It goes over a couple of pages. I'll try and sort of summarize it for you. In fact, Sam has indicated he's done really well with respect to property investing. I'll just read this first couple of sentences. I'm 40, married with 2 kids. We're both PAYG, earning around a combined $400,000 a year, and I've built a 12 property portfolio in the last 10 years or so, $12 million of gross value at an LVR of 55%. And he's done that using discretionary trusts and self-managed super funds. So look, that's a great outcome. 12 properties, 55% LVR. Would love to know, whether your home's included in that, whether that kind of boosts the equity that you've enjoyed over that period of time. I've seen a few of these property portfolios over the last sort of 20 or so years. I'm not suggesting that the way I talk about property investing on this podcast is the only way to do it, or that, there's not other better ways or equally attractive ways to build wealth. What I talk about on this podcast is sort of evidence-based strategies, and there's not many people like Sam that's writing in that has achieved those sorts of outcomes. Anyway, Sam's sort of talking about ring fencing debt, and that if you buy property in a trust, with a corporate beneficiary and go to some lenders that they will just assess the trust by itself without necessarily impinging on your personal borrowing capacity. And that allows you then to buy more properties and get more debt and buy more properties. And he said that you've got to try and buy in the same trust, buy properties with high yields. And also that if you can buy properties that have 20 to 30% capital growth in the first couple of years, that also then helps you in terms of letting that trust stand alone from its own borrowing capacity perspective. And Sam goes on to talk about how to make this strategy work, he's selling down his blue chip properties and investing more in regional capital city properties. He also suggests that once you've got 20 to 30% capital growth, even if the capital growth levels out, he's saying it doesn't really matter very much. Sam, you'll be really interested in my blog tomorrow. It's about understanding the internal rate of return of investments. The other thing too, I would say to people, I mean, you do see these sorts of case studies, and I'm not taking anything away from Sam. Tremendous job. You know, he's taking a lot of risk in terms of a lot of borrowings relative to his income. It's not something that I'd be particularly interested in or interested in suggesting, but, you know, hats off to him. He's doing well, or at least he has done well. I haven't, if you just take it on face value and what he's told us, but that wouldn't be fair for everyone. He must have $5 to $6 million of borrowings on $400,000 of annual income. That's more than 10 times employment income. And I acknowledge there's rental income in there as well. So of course, that helps with servicing, but I mean, it's certainly highly leveraged. There's no such thing as a free lunch. So if you're going to invest in assets, it really depends on the returns of those assets. To say that capital growth doesn't matter anymore, I think would suggest that you kind of misunderstand how property investment works. The other thing too, I would say, you know, having done this for nearly 25 years, is that it is possible to achieve some good outcomes over a relatively short period of time, 10 years. Whether that's repeatable and whether it'll get you to the next stage and whether you can survive that in terms of survive holding the debt for that long is another question. Building a strategy around maximizing borrowing capacity, I'd also be really cautious of. So that is choosing assets and choosing ownership structures that are going to maximize my borrowing capacity. That's not the aim of the game. The aim of the game is to build as much wealth as possible whilst taking the lowest possible risk. Investors that go hell for leather and borrow as much as they can, yes, it can work out, but it's a higher risk strategy and not a strategy that I'm going to talk about on this podcast. It's not in my wheelhouse. As I said, different people will enjoy different approaches. It's just not what I'm looking at. So if I went into a lot of detail on Sam's question here, I think it would be a podcast topic in of itself. But well done, Sam. As I said, look out for tomorrow's podcast. I think if you applied some financial analysis, particularly at higher interest rates, maybe you might take a different approach. Maybe not, whatever. Anyway, thanks, Sam. I appreciate it. Next question is from Leo. Quite thought-provoking, Leo, this question, and something I have spent a lot of time thinking about over the last 20 years. And I'll admit, I can share my approach and my view, but I don't know if I've got a finite answer for you or an answer that I have an extremely high level of confidence with. So I'll read it out. So Leo writes, something I've always wondered when looking at real estate investment projections is, how can rent increase more slowly than the property's value? If the property's value increases at X per year, let's say 8%, and rent is increasing by Y% per year of the property's value, then the rent should increase just as fast as, X should equal Y to keep up the gross rental yield. When I mention this, usually people respond by saying that the rent can't possibly increase at 8% per year because it would quickly outpace income growth, which seems like a reasonable argument. So people often project a lower rental increase rate in their spreadsheet, say 5% instead of 8%. But this means that mathematically, your rental yield will get close to zero over time. For example, after 50 years, the rent would drop from 4 to 1% of the value in terms of gross rental yield. What am I missing? So Leo, you're not missing anything. It's a really good comment. When we ran projections, we used to hold the yield constant. So that is that if a property is producing a 4% rental yield and we're expecting a 7% growth rate, that it'll earn 4% in 30 years' time. But I don't think that's true. In fact, when you chart rental yields over the last 40 years, they decreased between 1980 and around 2010. but they've been pretty stagnant since 2010. They haven't really changed very much when you look at median house rental and median house value and computer rental yield, that is. But the reality is, if you do have a high growth property, you're typically renting to people that tend to have lower incomes, can't afford to own that property necessarily. That's not all renters, but that would be most of them. And so if a property doubles in value over the last 10 years, it's not necessarily the renter's going to pay twice as much as they did 10 years ago, of course, right? So when you look at the average increase in rental income over the long period of time, the last 40 years, it's 4.3% per annum. So even if you're using 5%, if you look back at history, you go, well, even 5% is too high. It's true that if you take that over very long periods of time, you do end up with a very, very low rental yield. But if we're expecting very, very high capital growth, the idea behind that capital growth is that it's driven by demand, and it's demand from sectors of the economy, the top 20, the wealthiest 20%, if you like, that keep pushing these prices higher and higher in blue chip locations that have sources of wealth beyond just employment income or business income. Well, it could be business income, business profit, employee shares, inheritances, gifts, all these sorts of things. And because they're part of the, top wealthy percent in Australia, they're going to have those sources of wealth, and that's what's going to drive property values. But the cohort that are renting in these locations are very different. Their capacity and ability to afford is probably more closely linked to income, and not in every situation, but as a general comment. And so if prices increase by 7%, I don't think rentals can increase by 7% over a long period of time. So when we do our projections, we decide what do we want to use for a capital growth rate and what do we want to use for a rental income increase. And typically we go 4%, just because the long-term average is 4.3%. And we acknowledge that that means that the gross rental yield does compress over time. And we feel like, well, if we're doing projections and that is the outcome, we're happy to kind of live with that, given that it's conservative. And if it doesn't eventuate, we're in a better position. But I think if you look at the economics of who's renting and who's buying, who's pushing prices and who's pushing rental values up, I think it makes sense to be pretty conservative with the rental growth rates. Great question, Leo. It's something I've been thinking about for a long time, because the argument from some property people is, yes, no, rental yields will hold their value. And I think that's probably too aggressive assumption to make. Okay, next question is from Samir. Samir writes, I'm 46 years old and medical professional. I hope you can answer my question. I recently listened to your episode on the best performing super funds in 2024. It was good to get an update on the various funds and their performances. Before following the FIRE community, which is Financially Independent Retire Early, that's the acronym. So before following the FIRE community a few years back, I used to have a financial advisor who recommended Colonial First State to me. It's a wholesale fund, but not an industry fund. The performance has been compared to other funds mentioned by you in your podcast, see below, and I've got a chart here which I'll talk about in a second. Despite the comparable performance to an industry fund, I'm still looking to change to an industry fund if you suggest it might be worthwhile, expected long-term net returns. I'm not sure if I'm missing something. Also unsure if wholesale fund is something similar to an industry fund and therefore I don't need to change it. Look, it's a great question, Samir, so thanks very much for submitting it. Of course, I can't give you personal advice. If I tell you to switch, I'm not really telling you to switch. But what I can do is try and help you with that decision, if you like. So Samir's given me a table looking at long-term performance, so 10-year performance, for instance. And if we compare against UniSuper, which is the fund back in episode 315 that I talked about that I think is, my favorite, versus what Samir's fund has returned 7.2%, and UniSuper's done 7.7% over a 10-year period. So it's 0.5% better in terms of investment performance. And then when you look at total annual fees, UniSuper is about $1,800 a year and Colonial First State is around $2,200 a year. So slightly higher there on fees, about $400 a year circa, so 0.5% and $400 a year in terms of fees. What I'd be most interested in, Samir, is the makeup of the fees. So that's something you really want to think about. You haven't told me your balance, which is kind of important in this analysis. But the higher the balance is, the more important these percentage fees start to become, because in dollar terms, as your balance appreciates, those percentage fees really do increase. A wholesale fund, let's talk about that. What are wholesale funds? It's less common, or the advantages of wholesale funds have reduced significantly over the last 10 years as a result of the introduction of exchange traded funds, ETFs. Wholesale funds used to be available to individuals that invested several hundreds of thousands of dollars in one particular fund. And so what they would do, because they only have to deal with fewer investors, they were cheaper. But the way to get access to a wholesale fund would be to get onto a platform. So Colonial First State, Macquarie, Hub24, Netwealth, these are all platforms. And what these platforms allow then is that you've got access to all the wholesale funds, which means you pay cheaper fees, but you're allowed to then invest smaller amounts. You don't have to meet that wholesale fund sort of benchmark, if you like. So exactly the same investments, just lower fees, if you like. Look, there's a big push. I did a podcast more recently about this. There's really a big push for retail funds to become a lot more competitive with industry super funds. So that's obviously happening. And whatever sort of investment option you're in, Samir, it's done pretty well. But, it just could be all traditional market cap indexing, which is good. It has been good in a growth market, which is the last 10 years, but probably won't repeat itself in a market that might switch to value at some point in time. Just don't know when that will be, but it's probably likely to happen in the future. So the things that I think about then are fees and how much of those fees are dollar value and capped versus percentage relative to your balance. If you've got a high balance, that's a really important consideration. Gross investment returns, which we've talked about, which is half over a long period of time, UniSuper is 0.5% better off. And then understanding kind of how it's invested in the investment methodology relative to, the current market and what we expect moving forward. So again, I don't know all your details, but in your situation, I think I'd still be inclined to switch across to UniSuper. There's nothing there that's so compelling that would suggest, yes, I want to stay at Colonial First State. Higher fees, lower returns. And I just think, UniSuper's approach in terms of its actively managed, someone's managing the portfolio, will probably serve you better, at least accommodate some of the investment risks that are in the market over the next period of time, however long you're going to be invested. Anyway, that's what I'd be thinking about, Samir. It's not advice. I would maybe go and speak to UniSuper about it. They do actually give financial advice, I'm pretty sure, and they might be able to review the fund for you and recommend whether you should switch. Of course, they're employed by UniSuper, but at least they're going to highlight any negative factors that you need to consider. Okay, I've got a really interesting question now from Callie. Thanks so much for writing in, Callie. Callie writes, my question is about dimensional funds becoming dual access. I have a diversified investment portfolio constructed by my financial advisor. Within it, I've invested in funds like Dimensional's Large Australia Company Fund. It was explained to me that one of the benefits, among many, of working with a financial advisor is access to products that wouldn't otherwise be available on a public exchange. But if Dimensional creates dual access options, does that mean that the same products are now widely available? I'm hoping you can talk through this. Okay, let me unpack that for you. Callie's talking about dual access, and what it means is Dimensional now offer those funds in ETF format and also traditional managed fund format. Let me take a step back and talk about Dimensional. And I think it's worth talking about Dimensional from what do they do and then what their historic approach has been, because it's kind of interesting and it really does speak to sort of how the investment market is changing. So Dimensional was started in the mid-80s by a bunch of academics and Nobel laureates. Many of those that used to sit on the board, probably don't now, wrote most of the textbooks that I read when studying economics and investing and so forth at uni, probably 30 years ago now. Anyway, so, they're really noteworthy, really smart individuals. It's a really smart business in terms of how it puts funds together. And essentially how Dimensional invests is it starts off with what they call an investable universe. That could be a ASX 200 index. And the methodology or the ideal thesis is, of course, in the ASX 200, there's going to be stocks in there that we just don't want to invest, stocks that for statistical and factual reasons that just don't make a lot of sense. And so what Dimensional do is they do filter out some stocks, but then skew towards stocks that they think are better, that are going to provide better returns, and skew away from stocks that aren't. So we're not making massive bets as saying we're not going to invest, but we're just going to invest a little bit less, a little bit underweight than what the index would be. And there's three sort of filters that they use. Statistical analysis and filters is value, which is a price to book sort of measure. So that's looking, it doesn't want to invest in companies that are overvalued. Profitability, peer profitability. So in an industry, if a stock is has much better profitability than its peers, then we'd skew a little bit higher. And conversely, the reverse would be the other way. And then small and large. So small companies have a long history of generating better returns than large, so they'll skew away from there. Now, historically, Dimensional had this story that they want to only work with advisors, and in Australia, going back 15, 20 years, they would only work with independent financial advisors, so advisors that didn't take commissions, which I thought was very admirable, and we've been dealing with them naturally for a very long period of time. And one of their ideas was, 20 years ago, you had to go and do a course, a 3-day course to become an accredited advisor. You had to be independent. And the idea behind that is they want really sticky money, that if we make an investment in that fund, we're not going to just rip it out tomorrow and increase the fund turnover and increase fees and all that sort of stuff. They want long-term investors. They're going to ride it out and stay there with the long term. And so by having this accreditation process, it created that stickiness with the money. I almost fell off my chair last year when they announced they're going to have an ETF version of that fund. And it probably shouldn't have surprised me. But at the end of the day, ETFs are becoming incredibly popular, not only here in Australia, but all around the world, particularly in the US. And really, a fund manager to survive, they've got to be able to offer their products in ETF format as well. How does that impact their existing funds? Well, let's see. I'm not really sure. Let's see. But without getting into the detail, how a ETF is put together, you have what they call a market maker. And so they're the ones that provide the liquidity in the market, and they will then go and invest in Dimensional's, managed fund product. But it shouldn't really change that too much, because how an ETF is funded, and if there's a lot of buying and selling, the market maker deals with that. It's very different to a unit trust environment that is a traditional managed fund. So I've been prattling on here, Callie. I guess, there used to be a bunch of advisors that were really heavy into Dimensional, and they would only recommend Dimensional products. And I just think it's really risky to jump on board with one particular methodology. And I think there's a number of methodologies you should use. And we use Dimensional. They hold a significant part of our portfolio, maybe 20 or 25%. It's significant. They're very good. I like what they do. And I don't think having a dual access option, so an ETF version of a product, will really impact them in any material way. Okay, Kyle's got an interesting question. I know we're sort of a bit short of time, but I want to try and squeeze in as many answers to questions as possible. So Kyle writes, I really enjoy the Q&A episodes. Thank you so much for giving your thoughts on so many different topics. I was just hoping to get your thoughts on cryptocurrency as an asset class. I understand volatility and relatively young age of crypto as compared to other asset classes. However, if you were to change the question to, if you made up an entirely new asset class, what features of the asset class would you be looking for before you consider it to be a viable asset worth investing in? For example, are you looking for a trend in terms of sustained growth? Are you looking for global adoption and capital investment? Are you looking for decades worth of history before accepting it? If you were to apply these sorts of questions to crypto, why or why not would you consider it a valid asset? It's a great question, Colin, and I really like the way you've sort of framed the asset rather than, Stuart, what do you think of crypto? When it all comes down to it, you've got to have an asset to be an asset. It's got to have productive value. And so let's look at property, for instance, it has productive value. We all need to live in property for the economy to grow. We need to grow the population. It needs more houses in order to grow the population. Not everyone can afford to own a property. So, of course, then we've got renters. About a third of Australians rent. And so we need to provide for that market. There's productive value there. If you look at Commonwealth Bank or, some of those blue chip stocks, if you like, they make billions of dollars of profit each year. The profit is consistent, relatively consistent, and it's predictable, all those sorts of things. There's productive value there. If I look at gold, for instance, store of value, all these sorts of things. Well, gold has a lot lower volatility than crypto, so I definitely agree it's a store of value. But it also has alternate uses, where they use it as a medium of exchange, or have done in the past, also make jewelry and these sorts of things. There's productive value. So this is what I get stuck on with crypto, is that no one's really using it. And when I say that to someone that's a crypto investor, oh yes, they are. There's this and this and this, but they're not really using it. I mean, no one's really. The only reason people are buying crypto is because they think it's going to go up. That's the thesis behind buying it. There's no actual use for it. Now, that's distinct from the technology, which is blockchain, right? Let's separate those two, because blockchain has some use. And as I understand it, some crypto transactions, although this is really using blockchain rather than crypto, is used between major international banks as exchange. So I think there are some uses, but I'm talking at a retail level. Where CBA has, I don't know how many million customers, right? They've got a very big reach. That's where they're generating their money. So where's the productive value is kind of what I'm stuck on. So what I would like to see for it to become an asset class is that everyone starts using it as a medium of exchange. And maybe not everyone, but a lot more people than what it is today. If that happens, however, I think it would spell the end of crypto, because central banks are going to want to regulate it if it's going to start using it as a medium for exchange. So at the moment, I think most people, 99% of people, are only holding crypto because they hope that it's going to rise in value. And it's a bit of a self-fulfilling prophecy. It's almost a social Ponzi scheme, because they can get someone else to believe in it. It creates the demand and so on and so forth. But it's a great question, Kyle. And I think that's one, if you listen to great investors like Warren Buffett and the late Charlie Munger was brutal about crypto. And these guys have been around for many, many years. So I think to ignore their view and just to write it off as, like, these old guys, what do they know? I think do that at your own peril. But that was their major issue too, by the way. Not that it's unregulated. There's some issues unregulated, crypto exchanges, all these sorts of things. There's a bunch of issues there. But in terms of when you get down to it, where is the productive value? What value is this asset producing? And at the moment, I think the answer is very little. Great question, Kyle. Thanks so much for submitting it. And if anyone has any questions or feedback, I'm going to do a whole bunch of these Q&A episodes, because I'm really keen to get through as many of these questions as possible. I've got about 50 pages of questions, and they're all very interesting, so I appreciate it. If you have any more questions, send them to me at questions@investopoly.com.au. And until tomorrow, bye for now.